We'll call the agent. We'll ask questions. Lots of questions to the point where they say, stop asking questions, and that's totally cool. Why are they selling? When do they want to close? What do they want to be out of the property? Is there anything important that's not cash? The sales price is just one of like 10 different important factors of this equation. What's important to the seller?
Welcome to the REI Partners Meetup. We're your hosts, Matt Morrow and Richard Clark. This is a place where knowledge is shared, friends collaborate, as we help each other to succeed in both our real estate and personal goals. We are a group of like-minded individuals from across the country who are here to help and support each other. Investors, realtors, entrepreneurs, and many others contribute to providing diverse and practical content for our events, especially our mentors who enjoy helping new and experienced investors in their journeys. Thanks for joining. We hope you enjoy the show and encourage you to bring others who may find value as we invest in our collective future.
Cool. All right.
Good evening, everybody. Thanks for joining the call today. This is Thursday, October 19th. The REI Partners Wealth Through Real Estate conference. We're just going to be talking today. Matt Morrow and John Wargo with the Morrow-Wargo group are hosting this call, and we're going to be talking today about going back to the basics. My name is Richard Clark. I'm out in Western Pennsylvania and serving the Western PA area, Pittsburgh, Erie, and parts of Ohio. And I'm a private equities professional out here working with real estate investors, helping them to build a real estate empire from my end. Matt Morrow, as well as John Wargo and others on his team, are doing the same out there. We're going to do a roundtable of the attendees of this call today. And we'll start with one of our hosts, Matt Morrow.
I hate doing this. All right. Everybody knows me. I'm Matt. You all know my background. I'm just going to pass it on back to Richard.
No, you didn't.
That was good.
I like it. Brian's laughing. He gets it.
All right, so go ahead, Brian. iPad.
Yeah.
Hi, I'm Brian Siegel. I'm a realtor in Valley.
All right. Let's go to who else is on here?
Dimitri.
Yeah, Dimitri.
Hey guys, my name is Dimitri Dabarsky. Just recently met up with Matt and the company. I'm a pretty new investor, just starting out. So my first meeting here. Thanks. I'm out of New York. I live in New York, Staten Island specifically, but was looking to look for some deals in Pennsylvania, and that's how I came across with Matt.
Yeah, I'll be ready.
Yeah. Brian Walter, you on?
Yeah, I am Matt. My name is Brian Walter. I'm a full-time engineer and part-time wholesaler based in Allentown. Thanks.
Heather?
Hi, everybody. I'm Heather Rui. I'm a new investor, excited about learning more about investing, and I work full-time for the state of New Jersey. I'm a data analyst, so I love real estate. I love analytics, and I can't wait to do some investing and learn more from you guys. So thanks for having me here.
Awesome. Thanks. Stephanie, are you able to do a quick intro?
Yeah, sure. How you doing, everyone? My name is Stephanie Cortez. I'm from the Philadelphia area. I am a small investor just starting out. So I'm really excited to hear what's going on today, just gain what I can get from this information. So thank you for having me.
Awesome. We're going to do everybody in the room here. So I'm going to stop this. I'm going to start this. And we're going to do this. All right, so going around the room here, we are going to start here.
Hi, I'm Ken Morrow. I'm Matt's dad, and I am a relatively new investor, actually coming up on a 1-year anniversary of a 5-unit property we bought in Copley, Pennsylvania, and it's doing good. It's turned profit since day one. So looking to do more and coming here to learn.
Hi, I'm Aiden. I'm Matt's kid. That's it.
Don't even say you're related to me.
Just learn, getting into it,
What do you want to do?
invest. That's what everybody else is trying to learn here.
You're making this difficult, man.
Hi, I'm Ryan. I'm Matt's uncle. My name is Ryan. I don't know any real estate. I'm just here to learn and have some fun.
Hi, John Wargo. I work with Matt. I've been an investor since 2004 and an agent both here and in Colorado.
Recording in progress.
Oh no.
You're good. You should be good. Hi, everyone. This is CJ Sabo. I am a real estate agent here in the Lehigh Valley and part of the Morrow-Wargo group.
Hi, I'm CJ's wife.
Hi, everyone. My name is Abby. I am a new investor. I'm also a mortgage lender.
Put you on the spot.
I am Beth Remalley and I am here to learn.
Hi, everybody. I'm Kelly Baptist, not an investor or an agent, just here feeling it out and seeing if we can learn something new. Thank you.
Hey, I'm Ryan Leggett. I'm a licensed realtor and investor in Allentown, PA. Just here to learn like everybody else. If anybody is interested in going in on a deal with me, something short term, where my money's not tied up for too long with good returns, just let me know. And you can get my contact information on the website, or if you're here, you can also get my card. Thank you.
Didn't forget about you.
I'm Sarah Anderson. I'm new, looking to invest, and here to learn.
Cool. All right, Richard, here's the last one.
I think I just did mine. I'm Richard Clark. I am out in Western PA. I am a licensed realtor and an investor, and been an investor since 2018, and always looking to grow the portfolio. And I operate Pittsburgh, Harrisburg. Well, some of Harrisburg. I used to live in Harrisburg, but now I'm out here in Western PA now. So I do provide as much help as I can with new investors and helping figure things out. And anyone needs to get a hold of me, welcome to do so. My website is genesisopportunity.com, and looking forward to talking with everyone today.
Awesome. Thank you. All right. So we're going to get this thing on the road. If you guys on the screen can tell me if you see the PowerPoint when it comes up, please. Yeah. Can see everybody.
Yep, it's there.
Right on. All right. So tonight's goal is to talk about back to basics and basic deal evaluation. So everybody in the room has varying levels of experience. Everybody on the call, same thing. You guys are coming from a bunch of different backgrounds, locations. This meetup we have kind of formalized over the last 4 or 5 years. It started as 3 of us just kind of bullshitting about real estate, and now we have over 200 people on the mailing list, and everybody's interactive. Just kind of crazy. So if you know of anybody who'd find information valuable about real estate investing or just wants to talk and learn, have them contact us. We'll get them on the mailing list and we can go from there. So tonight's subject, again, is back to the basics and deal fundamentals. Here's a disclaimer. This is a picture that I'm sure Ryan forgot was on this slideshow, and Richard refuses to let me use it, but I don't care. So he won't put his video up, but that's Richard. He is there, and I hope you can all see that. This is a disclaimer.
I cannot believe you. Oh my.
About half of the people on the call and in the room here are licensed in some sort of real estate, mortgage, securities, whatever. This is not us giving you guys actual advice. This is us as investors and friends talking and learning. So please, nothing that's here is a representation of any of our brokerages, our teams, Richard's cowboy obsession, or anything else. So please keep this as education, but verify all the data you get here tonight. Everything that you see is just for education. Yeehaw. Yeehaw. You got it. All right. So fundamentals of real estate investing. Everybody here knows Robert Kiyosaki, his quote that I'm going to not be able to read here. The single most powerful asset we have is our mind. If trained well, it can create enormous wealth. If you don't know who Robert Kiyosaki is or any of the books he's read, the last slide of today is going to be a few of the publications that we've had that are out there that are very, very valuable to learn. Life-changing stuff. Very, very life-changing stuff. Hey, Mike. So, what is real estate investing? I know this is a simple question, but why do you buy real estate versus other kind of investments? It's because you're intending on getting a return on your money. It could be through rental income, future resale, appreciation, depreciation, lots of different things. There's different reasons why you invest in real estate: passive income, asset appreciation, diversification, and utility. That's a really huge one. Multiple people in this room and on the call here have purchased real estate that didn't think it would be the one thing that saves their life. And I always like to put Ryan on the spot. Ryan was a former client of ours. Now he's on our team, but Ryan actually purchased a 2-unit building in Allentown, lived in one. He was employed at the time. The other tenant paid us all bills. It was good. Then he got laid off. Now he's living for free in a building that he owns, and the other guy's paying all the mortgage. And it allowed him to literally not go back to work, get his real estate license, and come kick ass on our team. So real estate has utility. You can't do that with stocks, bonds, Bitcoin, gold. It all has value, but you can't actually go up, touch it, live in it, and actually have any type of utility with other investments. So this is powerful stuff. That's just one example of a lot of different things. Some investing strategies. Buy and hold is when you buy something and you keep it. Long-term rental versus short and mid-term rentals are different tactics, essentially, of long-term or buy and hold strategies. Everyone is very, very different. And we're going to get into these here in a little bit. But you buy, hold on a second. Here we go. You buy long-term rentals, short-term rentals, and mid-term rentals for the same generic things. You buy it for cash flow, you buy it for appreciation, and you buy it because it's not a different investment class. Flips and short-term cash generators are really the same thing. You flip properties because you want to earn money, not necessarily a long-term investment. The difference between money and wealth is different. And again, this is a Robert Kiyosaki principle that you guys should check into, and we'll talk about it here at the end. But being rich and being wealthy are two totally different things. Rich has lots of money. Wealthy doesn't need money. The difference is this guy has a lot of money in his bank, and it's just money in the bank. This guy doesn't need to work or worry about money in the bank because all of the stuff he has pays for his lifestyle. You can be wealthy and have a $0 a year income. You can be wealthy and live in a van in the middle of the desert and not need a job. You can also be wealthy and have thousands of units. So there's two totally different things, and it's all depending on what your long-term goals are. Many people here, most of the people on the call, are looking to either retire early, learn about, have some sort of passive income, or diversify their retirement portfolio. But this is where we're going to start. The BRRRR method, if you're familiar with buy, rent, rehab, refinance, repeat, is almost the most popular version of everything we're going to talk about tonight, because people do this without even knowing it. When you buy a piece of real estate, you fix it up, you rent it, and you do it over again. You're a real estate investor without even knowing it. And the more you do that, the better you get, the easier the projects become, the more complex you get. Next thing you know, you're buying apartment buildings, renovating them, turning them into XYZ. Everybody knows the PP&L building here in Allentown. That's going to become apartments. And it's pretty wild to see what they're going to do.
The tower?
Tower, yeah. Yeah, and a lot of other buildings too. Look at all these old silk mills and textile mills that are now apartments. There's use for all of these things out there. So BRRRR method is not just for single family homes. The premise behind a BRRRR method is that you buy something outright or with hard money, and we'll talk about that here shortly. But you buy it outright, you add value, you make it nicer than it was, and then you extract the value with a loan. Now you have a loan payment, but now this thing's self-sufficient. You don't have to worry about it anymore. And then you take that money you pulled out, pay back the bank, and do it again. And every time you do it, you get more and more money because they trust you. Okay. House hack and owner occupy is what we talked about earlier. Ryan was essentially house hacking. It's a term for living in an investment property or living in a flip as you're doing it. You're literally hacking the system by living in it. There are programs out there now that allow you to buy an investment property with pretty low down. And there are obviously risks to that because you don't have a lot of equity. But if it allows you to start off without a ton of cash, that in itself is a good deal. So there are two mortgage lenders here who can talk to you about that stuff. You guys know who you are. Mike and Abby, yeah, way in the back. Yeah. So there's a lot of opportunity out there for you to house hack and get into a property that you physically live in. And it's a very popular way to start off. Remote investing is something that a lot of people do. Some of the guys on the call, you live in other areas, you invest here or invest anywhere, but you really want to know what you're getting into when you invest remotely because there can be some catches. The biggest is you don't know the area. Everybody here knows the roads, you know, the town names, you know about what's going on. As soon as you pull up Lisa in the Grand Canyon, Arizona, who is an agent that we work with out there, and we send people who would like short-term and long-term rentals in the Grand Canyon area, we don't know anything about that area. So you want to know where you're investing, what the market composition is, and other items. So that's just something we'll talk about here. Syndication and crowdsourcing is another option where you become part of a large pool. You put your money into a pot. That pot's managed by people who are hopefully smarter and better at real estate investing than you are. They take that money, they buy something usually much bigger, and they do all of these methods, but on warehouses, large multifamily, commercial buildings, and then you get a return on your investment. Some of those syndication and crowdsourcing involve like portfolios of hundreds of small homes instead of large investment buildings, and a lot more. Richard, do you have anything on here?
No, I think that's great, Matt. The only thing I will add to this, though, is that you have to think about your strategy as an investor, what you're looking to accomplish. If you're looking to build wealth, you're looking at the buy and hold strategies, the BRRRRs, that sort of thing. If you're just looking to get some cash, flips and short terms might be a way to accomplish that. And since we have a lot of new investors here today, I would say that if you don't own your house now, a house hack may be the way to go to get started.
Yeah.
Yeah, Matt.
Good stuff. Sure.
So one of the things that I don't know if like new investors struggle with is like with all these options, like everyone always tells you like, oh, pick your strategy, pick your strategy.
Can you guys hear Ryan's question on the computer?
Do you have any advice for
Yes.
helping?
Okay.
Do you have any like advice helping people? Because I find it to be pretty overwhelming to be like, well, I don't know about this. There's just a lot out there.
That's a great question. You and I have had this conversation in length. So the straight answer is not all of these are for everybody. Some of you are not going to want to hold long term. Some people just want to flip. Other people just want to hold. Other people could do a combination. But in the beginning, the most important thing you could do is educate yourself on the benefits of each one. And we're going to go through all of these here tonight with examples, finances, and different equations that make it, good for you and your situation. And then you have to make that decision because you have to be all right with it when you go to bed at night. And the biggest thing we always talk about, Richard, John, everybody here on our team, you have to be a good person and a decent landlord before you become a good investor. Because if you're a schmuck and you don't treat your properties well, no one's going to live there. And we're in the business of people. We have to be good people before these assets become worthwhile. If you don't treat it well, you don't treat the people well. It's just like having a business where no customers come in. So we'll get into each of these, but just be educated about which one and just try. Doing the shotgun approach and trying all of them at once is sure to fail. But there's nothing wrong with failing as long as you learn and do it better the next time. Our goal as agents is to buy something and not fall on your face. If we could help you get into the game and learn it, there's a baseball game going on right now. A lot of people want to get to, but base hits are important when you're starting in real estate investing. You want a good deal, not a slam dunk. Slam dunks are nice. Some of us get them the first time, give us a big head, and we get crashed down a few times. It happens, but get a few good deals, and then learn, branch out. Flips can build cash to buy long-term holds. Flips can build cash to buy a BRRRR cash, make it into a long-term hold. You could interchange all of those. You can do all of them in sequence with the same property, which is kind of cool. That's a nice thing about real estate. And stock, you call your guys, say put this much there, and then it loses value and changes value. So, education. Assets. Oh, there's a PP&L building. We just talked about that. Residential, small multifamily is anything 2 to 4 units. The reason we break it up like this is because of financing rules. Anything above 4 units, even though it might be 5 apartments, is by definition going to be a commercial loan and commercial financing. Totally changes insurance, lots of things. So small multifamily and residential single family are things that you can buy as an owner occupant. You can buy these properties with different loan products and everything else. You're going to need a specialized bank and other products to buy everything else down the road. Large multifamily, they really say large multifamily is like 100 units plus, but for our intents and purposes, large multifamily is 5. Mixed use is when you have a house that is maybe an apartment over a hair salon, or over a restaurant, something like that, or maybe a small building with multiple property types in there. Mixed use, you want to be kind of careful, because if you have conflicting businesses, you could have insurance problems, you can have a lot of different things. You want to be comfortable with what you're getting into. Commercial is obviously straight commercial, where you have businesses, different sort of asset classes in the same building, all subject to different financing. Industrial is more like warehouses. Nobody here is investing in warehouses, but at some point you might be. These warehouses don't come from nowhere. These guys have been investing for a long time, and they come and they put these things up, and they're making a ton of money, even if it sits there vacant for 3 years until they fill it. It's crazy. So industrial is a different kind of experience. Modular park and campground is not really its own subtype, but it's important to mention because a modular park and a campground are essentially the same thing. The difference is, one, you have long-term tenants with lease. Campground, you have short-term tenants, which is like a hotel, but it's virtually just infrastructure. It's the land, it's the roads, it's water and electricity. Have fun, pay me rent. But they're not cheap. And some of our clients, if Eric's listening to this call one day, you will dive yourself into some really deep problems with modular parks and campgrounds, because it's a community. You have an electrical grid, you have a septic system that serves all of these different things. And when a septic system costs damn near $1 million, you want to pick your asset classes wisely. Real estate investment trust and funds, or REITs, you can buy essentially a piece of somebody's mortgage and a piece of a trust and a piece of all these different asset classes. We're not going to cover on that tonight. We're going to talk about the brick and mortar buildings, but that is an asset class that you can buy in. It's technically real estate. You just don't have to manage it yourself. You can buy into a fund and a trust. Anybody have any questions on that types of assets? I said assets, John. All right, risk versus reward. Obviously, investing is risky. I have to say that. But if you're going to pick a risk category to be in, the worst place you could put your money is your bank account. And anybody in here that's done some research on this gets that. And the reason I say that is because right now we're in a period of inflation, and that's where everything gets more expensive. But if your income and your money doesn't go up with the price of everything else, milk, eggs, gas, you're losing money. Inflation's, what's it, 9% right now? Is that where was right now? So all right, well, we'll say it's at 7%. If inflation right now is 7%, meaning everything else around us is going up in price 7%, your income and your assets need to follow that or beat that to be ahead, or you're losing money. Bank accounts, anybody that has a savings account knows that the banks are paying how much?
Joke, less than 5%.
Yeah, less than 1/10 of that. So money in a bank is important to be liquid, to have money you can spend, but money that sits in a bank is losing money every day. So pick an investment strategy and do something with it. Just do it educated. So being risky is all up here. Risk is a perception. And if you are not educated about the assets that you're investing in, shame on you, because you do not have to buy this 5 unit. You don't have to buy that stock. If you choose to, know what you're getting into. So nothing's 100% safe, but you can mitigate and control variables in real estate that you can't in other places. One of the things that we all can't control, we're all part of this ship, is we have cycles and the value of real estate fluctuates. There's times where you're just not going to be able to control the value of your property or whatever you own, and you have to be okay with that. You also are not going to control the value of your IRA or your retirement funds that you don't touch. You just watch the number go up every month on your bank statements. So would you rather put your money in something? This is not an actual question. This is rhetorical here. Would you rather put your money in something that's going to go up and down while you watch, or would you rather control what you buy here? And these are the reasons and the things you can control. Real estate is tangible collateral, and that's really important because tangible means you can touch it. You can do things with it. You can control if you buy it, where you buy it, how much you pay, what you do to it, if you value add, who lives there, how much they pay, when they move in or out, when you sell, if you pay taxes or gains on the profit, and the whole time you can go up and use it. Utility is similar. When we talked about this before, you can actually live in the property if you choose. A lot of real estate investors just buy a property to sit there. But if their life falls apart, you can uproot and move into the building that you own. It might suck. It might not be glorious, but it's better than giving it back to the bank. And sometimes giving it back to the bank is what you need to do. It's all part of it. That's why we prevent you from getting into the problem in the first place. Compared to other asset classes and money markets and stocks, precious metals, digital currency, those you have virtually no control over other than how much you put in and when you bring it out. So it's important to have those things as well, but don't put all of your eggs in one basket. Real estate is the thing. What was this? We were talking about this the other day. Of all of the top wealthiest people on the earth, 99% of them have a large real estate portfolio. Now, not to say you want to be the most wealthy person in the world, but they have their own problems too. But there's a common theme here. You know, there's only so much ground. They're not making any more of it. And Musk hasn't figured out how to get people to Mars yet and start selling real estate. So this is it, right? We gotta keep it here. And the moon's out of the question. You can't breathe there.
Yeah,
All
hey,
right,
Matt.
Richard. Yeah, sorry. I gotta go back to your cowboy
just
pictures.
one quick comment. I just want to point out to everybody that, in real estate, you're over time, you're talking about double-digit returns. You're not going to get that from the stock market. There's no way you can get that from the stock market. You're going to get much more profitability out of real estate over the long term, and it's secured in a sense because you're talking about a real property, as Matt mentioned. So just keep that in mind, is that you're in this business because you are looking for the highest returns that you can get for the amount of risk that you put into it. And the other thing I would say is that risk is directly proportional to knowledge. So the more you know, the lower your risk up front. So just wanted to point those two things out.
Yep. Education. That's all about it. And if you sit here and you get educated and you still don't buy anything, that's perfectly fine. We are not, and everyone on our team and agents on the call, we're not salespeople. These things literally sell themselves. If the numbers work, they work. You shouldn't be talked into an investment property. You shouldn't buy it with your heart. It should make sense. And if it doesn't make sense on paper, you move on. If you don't move on, shame on you. Same thing. You didn't research that stock you put your money into and realize the guy was corrupt and lost everything. So learn it. What's the score?
It's kind of like what Gordon Gekko says. Don't get emotional about money. Clouds your judgment.
Phillies just scored. So that's important to as well. Okay. That's 1-0. All right. Tonight, we're going to cover some critical terms. We're going to dive deep into some of these. All of these are critical that you know and understand the basis of before you get into. This isn't a lecture. It's not college. This is something that we want you guys to be totally aware of when you get into these things. Most people have real estate couldn't spit out the definition of these, and that's why we're going to review it. Return on investment. This is everything that we're here for. You're going to make an investment. You need to get a return. It measures profitability of the investment, dividing the gain over the initial cost. I don't have a formula up here because nobody likes math, but in real estate investing, you have to like math. We're going to get to a spreadsheet down the line that talks about this, but this is critical. Before you buy that piece of real estate, you have to know what your ROI is going to be. And This is critical right here. Your return on investment must be greater than inflation. So if your ROI is not greater than that 7%, you're losing money. But let's say you get 5%, it's still better than the 0.5% your money in the bank's get. Don't say that you want to settle, but everything's relative. If you get 5% and the market is tanking, still good. So equity. Equity is how much of something you actually own. If you have a house and you own it free and clear, you have 100% equity. If you just bought a house with a VA loan, which is totally cool, it's a great program, and you have 0% down, you have 0% equity. And that's important.
Factor in the money.
Exactly. And that's the piece with real estate that everybody forgets about. Closing costs, taxes, brokerage fees, all these different things. Unless someone else pays them for you, which does happen, real estate is going to be more expensive than the actual sticker price. You can't go to Walmart, buy a house, and pay that sticker price. It's like all those little fees they talk about. Know about them before you get in. Equity is very, very important when you're buying real estate. You have to have positive equity all the time. Negative equity could have its very few benefits depending on what part of bankruptcy you're in, but everything else you need to be positive. Okay. Build the equity through paying down the mortgage, increasing value, and all these other things. It can be leveraged to buy other investments. To give you a personal example, we purchased a single family house. It went up substantially in value. We pulled equity out for a home equity loan. We didn't do a HELOC at the time. We used that loan to then make a down payment on a 5-unit. That 5-unit was purchased at such a low value because it was requiring a lot of work. It doubled in value over the next 2 years. So money out of something I already owned, put it into something we didn't own that doubled in value. I took that money back out of the 5-unit and put it back into our house. It was an infinite return on your investment because we never took any money out of our house to begin with. We took equity out, deployed it. I didn't write a check. I took a few bricks and turned it into another building. If you guys do this in the same way, Ryan, you're going to be able to do the same thing with your property very, very soon. Use the equity as power. If you use cash, that's fine. But if you have equity in something, and if you buy the real estate right, you'll have a good amount of equity. Anybody have questions on equity? Cash flow. This is one of the biggest sticking points we have with new clients. And I'm going to talk as an agent now. Cash flow can mean a few different things, but it's the amount of money generated by the real estate investment after deducting all expenses, including mortgage, property, insurance, maintenance costs, and fees. Cash flow is not how much money you make from rent every month. If you make $1,000 in rent every month, you have to pay stuff. You have to pay your mortgage. You have to pay your insurance. You have to pay taxes. Maintenance is going to come up. And even if it doesn't come up, even if there are no maintenance costs or there are no vacancies, you still have to account for that. And if you don't, you're going to get burned with a big bill that you didn't count on. So cash flow is after you account for all of these expenses, there's a number left over. Sometimes it's positive, sometimes it's negative. The only way we're going to advise you to buy something is if that number is going to be positive after you do what you're going to do with it. Taking a negative cash flow every month is okay for some investors. If they're buying a house in Los Angeles that's going up in value $500,000 every year, you can take a hit on your monthly cash flow of $1,000 a month, equaling $12,000 a year if your property went up $500,000 that year. It's just a math game. So it's hard to think here, oh, I'm losing money every month, but you're really not if the area you're investing in is exploding in value. It's all in the long term. Short term, it looks like you're losing money. Long term, lots of value. Positive cash flow is crucial for ensuring the property covers its expenses. If you're remotely investing, positive cash flow is the only thing that you can prove on paper that this thing is a good investment. That's the only way to do it. If it's not positive, yes, you're still bringing in money, probably more than your mortgage and your taxes, but you're not actually bringing in money long term. If you save up a few $1,000s, then need to replace the boiler. It's just not going to work out for you at the end. On paper, it'll look fine until it doesn't. Negative cash flow or expenses exceed income can lead to financial difficulty and require additional capital to sustain. If you're investing by yourself, you have to bring money out of your personal savings account to pay for the repairs. If you're investing with partners, which as you do this more, you're going to have partners. You're going to have some pretty annoyed people because when you bought this, they gave their money in, and now all of a sudden they got to bring money to the table. So buy the property right in the first place. Be super conservative on your numbers. Anybody have questions on cash flow? Leverage. We were just talking about leverage. This is anything that you use to buy a property that's not your own. If you buy it with your own cash, you're not leveraging it. But if you buy it with someone else's money, bank, mortgages, private money, anything, it allows you to do a lot more. But it only allows you to do more if you do it with education. Because if you buy with someone else's money, a hard money lender, and you don't pay them back in time, not only do you lose the property, you owe a lot of money. You could end up in court and you're never going to get a loan again. So leverage is important because you can take that asset and do things with it. I know I don't like to bring up politics, but I'm not going to bring up politics behind the person. But the family of Trump has a real estate empire that is based on leverage. Doesn't matter what your background is politically. The man in the family built real estate, pulled the value out, built that. Added value, pulled out, built that. Thousands and thousands of times over. One initial investment, just keep spreading it all over. Leverage is powerful stuff. Some people, very popular people, choose to buy things cash. That's also fair, but you can't grow as quickly with just purchasing cash. You also have no overhead. The bank's never going to come take your property. You always have 100% cash flow, but the time value of your money sitting in that property could be a lot more. If you're happy where you are, keep it paid off. If you'd like to grow and maybe diversify more, use leverage. It can magnify profits when values rise. It can also put you in the hole big time when values go down or when interest rates change. If you have a commercial property or anything over 5 units, you're probably on some sort of semi-variable rate mortgage that changes every 5 years. So it's fixed for the first 5, and then when 5 years comes, it's fixed again, but at the new rate, whatever prime is, and it could be double what you started with. It could be half what you started with, not likely. But a lot of people are going to get burned here in a few years when they bought all these apartments, and now all of a sudden the interest rates are a lot higher than they're planning, and they have no control. The only way to avoid that is with cash or with a fixed rate mortgage, which are more expensive. Any questions on leverage? These houses on a monopoly board are an example of leverage. You use money to put a house there. Every time it goes around, the game's boring in the beginning, but it gets real dicey when people start paying $600 a turn. And when our 7-year-old at the time figured out that it's easier for her to sit in jail and collect money off of her properties, it was genius. Genius. You won not too long ago playing Monopoly.
On every single house.
Every single one. Unbelievable. Appreciation. Appreciation is the value going up over time. It's very, very basic stuff. If you look back to when this country was started a long time ago, the purchase price of the entire island of Long Island was, I believe, $22,000. The entire island. But that's before they had like real currency. They were still shooting each other at dinner, and the country didn't really exist. So the price of real estate fluctuates over time, but value and appreciation are really the same. They go up over time. If it doesn't, it's okay. It just has to go up over the long term. Remember the stock market? It refers to the increase in value over time due to demand. Appreciation can significantly contribute to long-term gains or losses, and consider both cash flow and appreciation when you're investing. For the new investors around, most people like to have a balance of a little bit of cash flow every month in an area that's increasing in value. That's a good plan. If you're investing only for appreciation, you're probably better off going to a Los Angeles, San Francisco, Naples, things like that, where these areas are super high demand. You're never going to get cash flow there. When you're buying a house for $8 million, you'd have to rent that for $80,000. No, Yeah, $80,000 a month to break even, which you know some people pay that, but invest in an area where the value is going up. And if you're going to invest in an area where it's not going up, be prepared to either be the next guy driving the city to improve the area or lose money on your investment. Depreciation is kind of the opposite. Over time, the value is going to go down, but not really. Depreciating something is through utility. It's because buildings break down over years. Your shingles are going to deteriorate. Your foundation is going to need work. Your electrical system is going to need upgraded in 50 years. It's just going to happen. So buildings and real estate naturally need repair and break down over time. The only thing on this earth that does not depreciate is land. So when you have a building, if you notice, there's always two numbers. There's improvements, which are anything that we built, and land never depreciates. So when we depreciate real estate on your tax return, which you should all be doing, the land will never lose value because it's always there until Mars happens. But the building and everything else can be written off if you choose in a certain way every time. And some of the guys on the call on the future meetup, we're going to talk about accelerating depreciation, where you can take a benefit on your tax return by harnessing those losses, because the building does decay every year. It doesn't actually, these buildings are going to be around long after we're dead, right? So you just want to be real that this is not a, oh my gosh, it's going to fall apart in 5 years. This is a long, long thing. You can take the benefits of the decreasing condition every year on your taxes. So thinking like an investor, if you're taking less tax liability now, you're actually getting more value every month. You're getting more cash flow, you're getting more return from this investment. So depreciation is actually a form of income. And you have to think long term about that. Anybody have questions about depreciation? There are whole seminars on how to talk about real estate and depreciation. It's pretty powerful stuff. And if you guys have done it before, it can go to the point where if you make $70,000 a year on rental income from your 3-unit, the depreciation of the property through the roof, the structure, and the standard depreciation you can take, if you don't itemize it, you could end up paying no taxes on that building, on that $70,000 of income, which is huge. That's why people do this in real estate, because that income can be wiped clean by the shingles and everything else. An important distinction that I didn't make earlier: flipping homes and long-term renting homes are seen very different on your income statement when you file taxes. Flipping homes is no different than going out and working a job, getting a paycheck. It's active income. Long-term rental is going to be seen differently. The income is long-term. It actually can be seen as income to you, like a job. Flipping is short-term capital gains, and there's going to be taxed as such. So if you make $50,000 profit flipping a home, be prepared to pay 20 or 30% tax on it. Whereas if you make $50,000 profit selling a long-term rental, that's still capital gains. You can do different things with that investment. So we'll talk about that then. Capital gains is the profit on top of it. And this is the thing that Uncle Sam and the government care about. They want to know how much money you make so they can charge you that much. If you buy a house for $100,000, you put $30,000 into it, that's $130,000 into it, and the market takes a crap and you sell it for $100,000, your capital gain was $0. You don't have to pay taxes. That's not good because you lost out big time. If you sell that same home for $200,000, your capital gain is $100,000. Doesn't matter how much money you put into it after the sale. It's what you purchased it, what you sold it for, and you're going to pay taxes on that gain. So a flip is not the same as a long-term. Flip is going to be treated as income if it's less than, what is it, 2 years, Mike or Abby? You remember what it is? If you hold it for less than 2 years.
I'm sorry, for what?
For active versus the passive income on a tax return, remember?
Well, I know it needs to be, you avoid paying capital gains on a primary residence if it was deemed to be your primary 3 out of the last 5 years.
Okay. What if you only own it for a year and you have to move out right away? You didn't plan on flipping it, but now you're there for less than 3 years.
Was it your primary or you bought it as a
primary?
don't pay any capital gains, as long as you make less than 250,000 of the sale as an individual,
Okay.
500 married.
But if it was termed as an investment property, you're paying capital
You're paying it
gains.
right away.
Okay. So capital gains, when you have a long-term rental that you sell, so you had it for a few years and its only purpose was to generate rental income, you're going to pay on the profit. Let's say that building you bought for 100, you sold for 300, good for you, but your profit was $200,000. You're going to pay a premium on that capital gains, unless you can defer that to something else. You can defer it by not selling it for 300, selling it for less, or you can turn that profit into something else through what's called a like kind exchange or 1031. That's the way people scale up and go from single family home to duplex, duplex to quad, quad to 10 unit, 10 unit to 100 unit without paying any taxes, totally legally, because it encourages you to keep churning the economy, buying real estate, employing people to fix stuff, keeping people housed. And the government incentivizes you by not paying taxes on that, by keeping the wheels moving and selling it. And that's a pretty cool thing. And the 1031 exchange program defers your capital gains, and it'll never go away unless our government officials stop owning real estate. And you know how that's going to work. It'll never, ever go away. These guys who write the laws know the tax benefit that real estate brings them. Return on equity. And if Jim was here, he's up there in a weird cardboard cutout, but if Jim was here, he would love return on equity. This is what you talk about with investors. Profitability and efficiency on the investment property, and it measures the return generated by your equity into a property. So if you have $50,000 that you put in, what is that $50,000 in the future? That's your return on equity. Not necessarily return on the cash. That's a different one. We'll talk about that shortly. But it's a useful tool for comparing different real estate investments and opportunities. So when you're talking to new clients or you're a new investor, we're going to ask you, how much money do you want to make on your investment? This is what we're talking about. How much money you put in, what's your return on that? Because if it's not good, you might invest somewhere else. I'll send this out afterwards so you can read all these details if you'd like. I was hoping Mike would be here tonight, but he's not. I'll send him this anyway. This is our friend Mike and his inspection company. We've been using him for quite a while. Due diligence is another critical term. You need to investigate the property. He comes out, he'll fly his drone, he'll crawl on the roof, he'll get in dirty looking at everything. If there's something wrong with that property that's not superficial, there might not be a way of knowing it. Home inspectors and agents and investors look at the things you could see, but you can't be invasive when you're buying a place unless it's in poor condition to begin with. It's critical for making sure there's not major obvious issues when you're buying something. Home inspections have been kind of tricky lately because they are not very common because of our market, but they're coming back. We have listings right now with home inspections on it. It is what it is. You know, you have to roll with it. And if you want an inspection on a property and that's your condition, that's your condition. Investors from other markets expect home inspections to be part of their offer. And some other are surprised when they realize that people are not buying them without inspections right now. So
Is this a once and done thing? It's they can come out, do the inspection, and then it's done?
For the purpose of,
or is it an ongoing, like radon? You get a measurement, and then before you buy the house, you get another measurement on it, see if it's going up or down?
so for this, we're talking just general due diligence beforehand. Radon specifically, they have to check it or they have to drop it, and then they come back a few days later, 24 hours later, and pick it up. But we're talking about when you're walking through, you want to check all of the back of the property, everything you can find. And it's not just the physical condition of the house, it's the tax records, making sure it's zoned residential, that people can live there. Some people build houses on parts of the land that shouldn't be there, or they build a house next to a river and get confused why it floods. You want to do background research on it, and that's something that we do all the time. Any questions so far? Cap rate. This is one of those things that confuses a lot of people because the cap rate is a relation to the net operating income and its value. A cap rate is a formula that we use to see how high the return is going to be on an investment. Depending on where it is, the cap rate could or could not apply. When you're buying single family homes, a cap rate or a capitalization rate isn't really practical because your rents and your income don't really match the value of the property. When you get into multifamily and commercial, cap rate is the only thing that matters to a lot of investors. So a high cap rate means a higher potential return on your investment. Lower means lower potential. And that's kind of an inverse way of thinking about it. Lower potential for a return on investment means you're buying something that doesn't have a lot of meat on the bone. Low cap rate means there's not a lot of room for profit. High cap rate means there's a lot of room for potential profit. It doesn't mean there will be, but something like this, you see how a higher purchase price, the lower cap rate, a lower purchase price is a higher cap rate. So of these two, the same building, when you purchase this building at $1 million, your cap rate's higher. If you purchase it at 1.5, it's lower. So which one of these are you going to have a higher potential as an investor of profiting from? This one. So you want to buy it high and sell it low. Ideal. And this is totally based on how much you're bringing in income-wise and how much the expenses are. So if you want to sell an apartment building, what you do is you buy it, you fix it up, and you get people in there paying really high rents, and then sell it then. But if it needs a lot of work and you didn't want to do the work, someone could buy it lower, do all the work, and now all of a sudden it's worth a lot more. Any questions on cap rate? After repair value is something that we talk about with every investor. What is this property worth after you buy it? And it's fixed up and it's ready to be sold or rented. That's the after repair value. It's an estimation of potential market value after it's undergone necessary renovations. It's critical to determining what you offer for this property in the beginning. Because if the property is not well rehabbed and it's not turnkey, you need to, work backwards. How much are renovations going to cost? How much is it going to cost me to hold this property for a few months while I do the renovations? And how much can I pay for it? After repair value is very important. When we talk about property evaluation, it's the next section here. Every time you look at something, it should be going into a deep dive of the finances. This is a spreadsheet that we use. You're more than welcome to use it. If you'd like a copy of it, just shoot us a note. We all use it for every one of our properties. It shows market rents. It shows purchase price, vacancies, building reserves, repair and maintenance. And where we talk about profit, I'll show it up here. You have rent for each of the units, expenses down here, your vacancy. So you want to account for vacancy every month. Property management, if you're using it, reserves, insurances, utilities, and then down here. So this is a minus 289 every month. Net cash flow. You take that away, you can see that your income's high, but after you take it away out of your expenses, it's low. This particular property was under rented. These rents should be about $300 more per apartment. So when you buy this property, you put some work into it, it's automatically a positive 400. So this one was actually a good deal. When you're evaluating a property, you want to locate it, evaluate it, investigate, interrogate, estimate, offer, and start getting to work. Location is important. When you buy something, you want to know where you're buying it from. You want to know the background of the property, the background of the town, the future of the town. Consider future developments, transport amenities, all these different items. Things that can increase the value of a property, you want to know. Things that can decrease the value of a property, you also want to know. We just had a client who had a piece of land they were going to build on. Power company came through, put high tension power lines right through the back, through an easement. It's probably never going to sell, ever. So now they're looking at alternative ways, throwing up a pole barn, running out the pole barn for $1,200 a month. That's the only way they're going to get stuff done on here. So learn where you're buying. Evaluate the local job market, schools, and census data. If you follow this link, it'll take you right to the census website. It'll show you where people are moving, nice fancy graphs, and it'll show you all the details about different areas. If you're from the Lehigh Valley, you know this is a pretty hot spot for people to live and invest, but people on the call are coming in from all over the country and their area might not be like this. So you want to educate yourself on where investing.
Did they get any money for that?
Nothing.
government just comes in and does whatever they want.
It's like the airport with eminent domain.
So much for having the rights. God.
Yep, and the power or the pipeline too. The pipeline's going here, but I own that land. That's great. It's going here. Start smelling funny. Call somebody.
They have to give you a fair market value. They take it.
Not if they take it, yes, but they didn't take it. They still have grass under it. Power lines go above it. It's ridiculous. Location continued. All of a sudden, you start having tails growing out of your back. Different ways to locate a property. You find it on market. Work with somebody you can trust. Agents have knowledge of deals coming from their client base, but not everybody likes to work with an agent. It's totally cool. I don't buy properties with a real estate agent. We find them beforehand. And that's part of it. If you want to be an investor, you can find them beforehand yourself. If you find them off market, they can come through wholesale, private sale, word of mouth, bunch of different areas. Auctions, foreclosures, tax and sheriff's sale. You just want to be careful where you get stuff from. It's not a valid and verified source. Private sale is obviously the best way and the best monetary way to get in a property because you lose that biggest piece of competition right now. Other investors, other buyers are getting very, very aggressive and they're driving the price up. So if nobody knows about that property you're buying, you can make a good deal. Richard, do you have anything?
No, it's great, Matt. Keep going.
Anybody have any questions? Everybody asleep on the screen? Yes, CJ made a great point. Do your research. And if there's a Starbucks or a hospital or a Chick-fil-A being built, you're probably investing in an area that's not losing people. So,
how about that? Yes, McDonald's, Burger King, they do all the research.
Yeah, those companies do a lot of research.
Yeah. People are leaving.
Right. I gotcha.
All right. Evaluate. It's not just the purchase price. Everything is a giant equation. All the financial aspects. Purchase price, after repair value, repair cost estimates, depreciation, and what you plan on doing with this thing long term. You look at a flip differently than you look at a buy and hold. So just make sure you're evaluating the property correctly. Our clients use the spreadsheet to see if the item pencils out. If the item pencils out, we call, do a bunch of research, talk to the agent, do the deep dive into the background, tax records, all that. And then we put it through this program, which is fantastic to run numbers on it. And it calculates all those expenses for us. You want to make sure you include ongoing expenses, property maintenance, taxes, HOA fees, anything that's an expense has to be in your numbers. And cash flow projections long-term are very important because you want to know what this thing's going to do in 3, 5, 10 years. If you don't know what it's going to do, you might as well not buy an investment property. The whole thing here is a long-term play. When you're investigating properties, these are things you want to look at. Beyond aesthetics, electrical, plumbing, foundation issues. You want to examine structural, mechanical elements. Overlook plumbing. Be very, very costly. I'm sure most people recognize what this is up here. That's knob and tube wiring. At one point, 70, 80 years ago, that was like the space shuttle. This was the most advanced thing in the world. It's a porcelain nail they put into the wood and they wrap the wire around it because it's an insulator. It didn't catch the house on fire until it caught all the houses on fire because the system was overwhelmed. Now all of a sudden, it's essentially blackballed because it's not safe. Knob and tube is not unsafe by nature. It's unsafe because in the 1930s, you didn't have a vacuum cleaner running at the same time the central air machine was running, at the same time 12 Xboxes and your Wi-Fi was running. They had 3 lamps and a few outlets. That's it. It was overloaded. So you want to make sure that stuff like this is not in a house you're buying. If it is, and you see it, replace it. Know your numbers beforehand. Make sure it's done. A lot of the old houses, it's everywhere. You just can't see it. So you have to beware. Testers, home inspectors could find most of this, but if it's buried in a wall, we're not going to find it. The other thing down here, this is an example of a flood zone. You're familiar with the city of Philadelphia. This is Camden with the aquarium. This is like the Ben Franklin Bridge right here. So a flood zone is anything around a waterway, and you can see different layers of a flood zone. So this is active water. This is where a normal 100-year floodplain would bring the river on both sides. And this is a 500-year floodplain. All of these places are going to be underwater at some point. FEMA designs this map. They make sure that it's current based on their models, and it changes every year. So when you buy a property, make sure that you know if it's going to have water in the backyard that's not in a pool or not. It's important to know because you're going to have some sort of flood insurance if you have a mortgage. It will be required. And if you don't have a mortgage, you're buying cash. When you get a mortgage on that to get your cash back out, they're going to make you get flood insurance. And flood insurance can be as expensive, if not more, than your yearly taxes combined. And it will kill every bit of your investment. So, since you don't want a house that's going to go into water, there are entire towns here that are in flood zones.
And there is a push at the federal level to evaluate the floodplains. So I definitely expect if you're here in the next few years, I probably expect that to change.
These are maps designed by the federal government and FEMA for risk. And risk changes every year. And whether you believe global warming or not, you can't deny that Florida, Louisiana, and Texas are getting more and more underwater every year when storms show up. And same thing here, it's getting less predictable. So expect flood boundaries to be expanded as time goes. These are just two versions of investing in a property. Environmental factors and hazards, super, super high. They might not be in a flood zone when you buy it, but if it is when you sell it, it's out of your control. Unless you get elected to the FEMA board of governments.
Don't buy close.
Interrogate. This is something that we love doing. Every time one of our clients, or every time we personally are looking to buy a property, we'll call the agent, we will ask questions. Lots of questions to the point where they say, stop asking questions, and that's totally cool. Why are they selling? When do they want to close? What do they want to be out of the property? Is there anything important that's not cash? The sales price is just one of like 10 different important factors of this equation. What's important to the seller? Sometimes the time is more important to the seller than the money. Other times, something like the value to the property because they have a family connection is more valuable than the money. John and I had a deal earlier this year that it was a modular park, and it was a $700,000 and almost $800,000 listing for a 30-pad modular. Sounds great. It needed a septic system, and the owner, who was living in the park at a house, so it was a duplex on the land, was part of his family for a long time. He lived there, managed the whole thing. What did he pay for that place? $800,000 listing.
400,000.
50% off. Because our client bought it, was going to take the septic out anyway, and allowed the guy to currently live in the house on the property for up to 1.5 years rent-free. That was more important than anything to this guy, to the tune of $400,000. You never know. You never know. Just ask the question. And the agent representing the seller should be able to just tell you flat out what's important to the seller. Sometimes they get offended, but screw them. It's your job as the potential buyer or as an agent to ask the questions. Verify contradictory info. If the square footage on tax records is different than the listing, you might find yourself a house that has more value than the owners know. If you have a 2,000 square foot ranch that only has 2 bedrooms, you might want to make that living room a little smaller and get a 3rd bedroom out of it, pulling $50,000 out of nowhere. Your value could be there. So look for options that don't exist or conflicting data. Estimate repairs. If there's any repairs needed, you want to get a quote. Unless you're licensed and you're going to be doing the work with a contractor that's yourself, have somebody get numbers for you. It's good for negotiation if you ever have to, but every time we go through a property, the contractor gives an estimate to be presented to the investor, and that is because he's going to do the work for that number. He'd be here tonight, but he's at home sick. So when you go to estimate repairs, get a good idea of the things that need to be done. If you're doing the repairs yourself, round high. Always give yourself like a 20% buffer on repairs because you never know what's going to go wrong. Ways you can increase value by splitting utilities. Somebody have a question?
No, go ahead, Matt. I got a comment on this too.
You can split utilities, get the tenants to pay for more of their own part of the pie. That's good. when you're doing any sort of work, electrical, plumbing, HVAC, permits are a must. You have to get the permits. If you don't, when the maker comes, when you sell that property, they're going to flag it that you didn't do it with permits and you're going to be paying for it. Every place we've been buying in the city of Allentown lately with clients, there is a shit list of all the permits that did not get pulled appropriately. And it's going to be flagged. In the cities, at least around here, that's where it's going to happen the most. Allentown, Bethlehem, Easton, definitely New York, definitely Philadelphia. Any municipality that requires high level inspections, you could probably get away with it in the more rural areas. But just get the permits, make sure it's done right. It's really for safety. Richard, what was your comment?
Just real quick, I just want to, we got some new investors here. So my recommendation is when you're looking at properties and you're determining whether or not what the repairs are going to be, make sure that the bones are good. Make sure it's, the foundation's good. Make sure that there's nothing big that needs to be done to these properties, because that's where you can really run into problems in terms of cost to repair. If it needs a roof, that's usually not a big deal, but you do need to get a quote for it. Get a quote for everything, in fact. But just be careful about purchasing properties that, if it sounds too good to be true, it probably is. There's usually something very wrong with it. You need to discover what that is before you would put your money into it.
Yeah, that's good. Good advice. When you find a property, you evaluate it, you did your due diligence, the numbers work, everything looks okay, you make an offer. An offer can be a simple one-page paper on a napkin. It could be an agreement of sale that's 14 pages long. The big thing with offers, it has to be based on what you feel this property is worth. It doesn't matter what the person's asking. It doesn't matter what the market says it's worth. What do you feel as an investor it's worth? To our client, that modular home park was worth $400,000. Doesn't matter what he was asking. That was his number. And to be a good investor, stick to your numbers. Make sure that you do not buy anything emotionally. And if you go off of your numbers, you're buying emotionally, and it's no longer an investment. You can't be a retail buyer as an investor. You want to have a deal, and a deal comes when you buy the property. I love these guys. These are some clients. They found us online. Young couple. They bought a house in Easton. They are super grateful for the whole process because they didn't know anything about their new life as investors. They're house hacking their first investment. It was a few months ago, and they're just tickled pink to be in a property that's going to pay them long term one day. These are the steps during an offer before closing. I'm not going to go through all of them. I'll just mention the points. After you prepare for the offer, you submit it. You get the seller's response. They either like it or they don't like it. A seller is either going to say yes or no, or something in between. Anything other than a no, however, is room for more talking. So if they just don't ignore you and they say, you might be close. You never know. Keep talking. Negotiation is a slippery slope sometimes. You want to make sure that you do it tactfully, professionally, because you never know when the other person could see like, hey, I'm done. I'm out of here over $1. And we've seen deals fall apart the morning of closing over items that had a value less than $100. It's ridiculous. But the investor knew their value, and that put it $100 over. So I think it's kind of ridiculous. I would have given the $100 to keep the deal together, but out of principle, they made a business decision.
This couple realized the value they had in the property and actually came up a week before closing, came up $4,000 just to make the deal work, because they knew that $4,000 would pay them dividends moving forward.
Yep, $4,000 now for a $20,000 price increase long term. There's things that you could do to keep the deal together. You can negotiate. You can change timelines. Not always monetary. We've sacrificed our commission in numerous deals before, sometimes taking zero just to make it happen. It's the right thing to do. Now, if you're buying a deal off market, you don't have an agent. I can't tell you how many appliances I bought. My second deal, I actually bought all the appliances because I didn't know the contract well enough. And it sucked, but it was there. So learn what you're doing, make sure you know the contracts and stuff well. Once they accept the offer, you go under contract, and then you go into a contingency period. If you have contingencies to review inspections, loans, mortgages are a contingency, things like that. And when you're ready, everybody gives the green light, then you close on the property, and that's really when it begins. If you buy a property with tenants in place before closing, you need to introduce yourself as a new owner and then have a plan of paying rent, things like this, because it's day one, you're now the game in town and you're the one liable for everything, which is the real big part. Once you get to work, you got to figure out how to manage this thing. Are you going to do it yourself? Or are you going to hire a property manager? You got to increase value over time, but if you have a rehab, now all of a sudden you're not having an investment, you have a really pretty property, which sounds great, but you need to have a balance between good quality and aesthetics. And the whole time you need to be a good person. Fix what need to be fixed. Never underestimate the power of tenant rights. Tenant rights are everything here. Landlord-tenant law will prevail and it will put you in jail. Make sure you know where you're listing or where you're renting, the state you're renting in, and the local rules, because there are things that you can and cannot say to someone who lives in your house. Doesn't matter if you own it or not. Caveat being is if you live in that same building as that, Ryan, you have a 2-unit. You have certain control now because you live in close proximity. If you have a house with multiple rooms and you rent the rooms out, you have ultimate authority. You can say, you can discriminate, essentially. The only way you can is if you live in the same space as this person. You don't want to. But outside of that, you must follow the rules when it comes to interviewing, moving tenants in, collecting rent, changing tenants' lease terms, selling the property. It all has to be accounted for. And in real estate, our business is people. So these clients for our business, your investment properties clients, are tenants. I'm not saying to keep them happy because you're never going to. You just have to be cognizant that they're people too. Their incomes aren't going up the same everyone else's is. And you immediately are the person who's the bad guy that has all the money. So just be prepared to, have those conversations. These are things that we covered last year at one of our meetups. This is a really good meetup. It's online on our YouTube channel. These books are fantastic. Tax-Free Wealth is written by a CPA. He's the accountant for Rich Dad Poor Dad for Kiyosaki. A bunch of Bigger Pockets book on here. Again, there's a book on the top that Trump wrote with Robert Kiyosaki. Gary Keller, the guy that started Keller Williams, he wrote Millionaire Real Estate Investor, which is a really good book, not just the Keller Williams. Good to Great is one. Michael Collins wrote that. It talks about different companies and how they've made the jump up from good companies to great companies. And the difference between good companies and great companies is that the leader is perfectly okay not taking the credit. That's the single difference between every company that went ballistic and ones that just went okay. Not to say Walgreens isn't an okay business, but their competitor took off. Bethlehem Steel was a good company. The other steel company that's still in business and has been going crazy ever since was actually in this book. And this is a 40-year-old book. So the biggest one on here, though, is this Never Split the Difference by Chris Voss. I'm sure some of you guys have read this. This guy, he's a hostage negotiator for the FBI. And he applies the principles of negotiating with terrorists to real estate investing and to business in general. It teaches you how to listen as a tactic and how to really get what you need out of it. Not to take advantage of people, but to get what you need. And then on the top here, for anybody buying real estate, Evicted is a book that I never thought I'd actually read, but it is the view of a tenant. And it's important to understand your clients. So when you're in a building that's being sold and you're being evicted, you have to know what the other side's feeling before you just become the asshole that kicks everybody out. So good person, then a good investor. This is all online. We go into the deep dive with all these things. What kind of questions we got? Everybody still on here? Oh, we didn't lose anybody. Look at that.
Hi.
All right. If you wouldn't mind, if it has a question, I'll start on the video here. I see Heather. I'm going to have you go first.
Thanks, Matt. That was like really great presentation, and Richard as well. Thank you for your input. my question is about FEMA. I was looking in a town and started to think that this whole town must be flooded, and looked elsewhere. But what is the official, legitimate, accepted way of finding out if a house is in a flood zone and it's going to be troublesome, or if it's right on the line, you could probably assume it's eventually going to be part of that flood zone. What is the right way to look at the FEMA website and their map? Did I pose the question right?
Nope, I had you on mute. I'm sorry, that was my fault. I'm going to share this with everyone here. Let me know if you can see this, Heather. This is right on FEMA Flood Map Service. If you just Google it, CJ said it before, Flood Smart. There's a few different services, but if you go to any area, there's different panels on the flood map. Then you can go in here and you can type in an address and it'll put a pin on it. Or if you just zoom in, like if you go here to Northampton, the website is very clunky. So if you don't have good internet, prepare yourself. Anything that's hashed red and blue is underwater 100% of the time. This, I think, is some sort of stream that runs up under here. Anything that is a waterway is labeled. You can see the labels here at the bottom. It's hard to see on the Zoom call. A floodway.
Right. And
then you can see the different floodplains based on this metric here. The 100-year floodplain and the 500-year floodplain are just a computer program that FEMA designed to show you the risk based on elevation and water history of what the flood risk could be. So to answer your question straight, if you buy this house right here, I don't think any of us could tell you that it will or will not flood, other than it's pretty damn close to an area that's going to flood. There's houses that are up against hills that'll never flood, but the map has it. Like here, if you're from this area, you know that going down Bridge Street in Catasauqua up till the bridge here, this is a really steep hill and it's probably 70 feet of elevation change. If that water comes up that hill and touches this house that's right here, the PP&L building is underwater. I mean, it's just one of those things that this map is super critical to show where, and you can go anywhere with this. So to answer your question, if you come down here to
I think so. That house that is right next to the zone is the next step to call the insurance company and say, hey, is this, would you require flood insurance for this house, or because it's next to the zone and not actually in the zone, there's not going to be flood insurance required by the mortgage company?
You definitely they have tools, and correct me if I'm wrong, guys, but you guys have tools that you could see if this is going to require flood insurance.
I think the next step would be to get a topo map and see the elevations, because the closer the lines are on a topo map, it's a steeper hill, and you'll be able to tell if it's a hill or not, and it gives you the elevation.
Yes, Matt's house is literally 50 feet from the river, but it's also 100 feet above the river.
Right.
But you wouldn't know it by looking at
Right.
that.
So if you got a topo map, you would see that the lines would be really close together, because I think they measure every 10 feet. So per line. So if their lines are really close, that means it's a real steep hill. So you would see that. So is there any study that overlays a topo map on the floodplain map?
I'm not sure of that. All I know is I'm not going to guess. There's a topographic map here. I always just call the lender and say, hey, is it required here? Or a flood insurance company would know. Because this will get you close. But this is a good website for that. That answer your question, Heather?
Yes, it does. Thank you. Thank you.
Sure. What are the questions we have? Anybody else on the phone?
Yeah, I'm here. Is it possible, could you explain a little bit more the 1031 exchange, like maybe using an example of how that would work if I were to want to like maybe get like an apartment building or something like that? Like how exactly does that process go?
Sure. So a 1031 exchange, it's section 1031 of the US tax code. That's why it has its name. And the 1031 exchange is used to offset the capital gains you're going to make purely on the sale of an investment property, a money-making property. So when you sell a $100,000 house for $200,000, in order to avoid paying capital gains on that $100,000 profit, you have to reinvest it into something that's equal or greater value. So you could take that $100,000 and turn it into something that's $500,000. But it has to be equal or greater value in similar asset class. Anything in real estate is going to qualify for it. It could also be 5 single family homes. It doesn't have to be something bigger. People always think of a 1 unit has to turn into a 10 unit. It can be a 1 unit turns into 5 other 1 units. That's perfectly fine. But what you want to do with a 1031, this is super critical. If you're going to consider using a 1031 exchange, make sure that beforehand you contact a 1031 exchange company or a lawyer who is very experienced in it, because these transactions are very critical to the process. The sale of your first property, every penny must go into an escrow account for the next sale. You can't touch a penny of it. The second any of it comes back to you, it's all taxed and it never will go back. So if you're interested in doing a 1031 exchange, you want to know and learn about it long before you actually want to do it. Because if that intermediary messes up the process, or if we misunderstand it, you're going to pay taxes on it and you're buying a new building you committed to. There's a very short timeline too. You have 45 days to identify a property to purchase. And I believe you have 180 days to close once you do that. So it's definitely a good tool to offset paying taxes, but you need to know a lot about it beforehand. Did that answer your question, Stephanie?
Yep, thank you.
Sure. Anybody else on the computer here have a question? How about everybody in the room here? Anybody have something?
Philly's lost.
What? The Phillies lost. Sorry.
Yeah, it was a walk-off single. 2-1.
Sorry about that.
Yeah, it stinks.
I guess we would have had the call on Wednesday night. This wouldn't have happened.
So is cash flow the same as cash on cash return?
Cash flow and cash on cash return are not. Cash flow is the money you get every month.
Right. Okay.
After expenses. Cash on cash return is if I take this dollar and I put it into that property, what's my return on that dollar?
Mhm.
Cash on cash return is essentially the same as if you put $1 in the stock market and $1 in real estate, what's your return on each? And that's how you compare what's a good or a better investment.
Is there a certain percentage that you look at?
Better than inflation.
Oh.
Yep. Yeah. So you definitely want it better than inflation. Most people, for us, when we're dealing with investors, want at least 10 to 12% return on their investment or cash on cash return.
Mhm.
And if it's more than that, great. If you use a BRRRR method to buy a property cash, refinance everything out, and you have none of your personal money left back in, your return is infinite because you don't have any money in the deal. You brought it all back to you. So obviously we look 15% or more, but we're seeing a lot of people get in around 12, depending on where they go. So cash flow is actually the money that comes to you every month after expenses.
Right.
Cash on cash is your actual return. What other questions you guys got? Nothing? All right, cool. Richard, do you have anything?
No, I think that was a great presentation, Matt. Thank you for having it. We should probably get into a little more detail in the future on strategies. And I think that that'll be something that will kind of take it to the next level of what we need to teach people. So, but yeah, great presentation. Thanks everybody for joining. We're right at 8 o'clock. So want to thank Matt for an awesome presentation, and unless anyone else has anything else, I think we can probably stop the recording and move on.
Sure. We have a few future subjects I just want to mention really quick beforehand. In the coming months, we try and do a call once a month. We do skip some during the summer because we get super busy, but dates and times vary. So keep an eye out on the email. If you have any interest in the future, our friend Mike Supp, who's a home inspector, he is going to do a presentation for us on a future meetup. It's going to be a home inspection in person. We're going to be here. He's going to be there with a film crew or his phone, and he's going to be doing an in-person inspection as he goes through. So everyone will be able to see it here. We'll see it on the phone, and then we're just going to have to wait for a vacant property that we can actually meet at one day and go through. It's tough when you have tenants and stuff in place, but that's going to be one. The other, our friend Adam, he owns a company that does cost segregation. He has a lot of experience with depreciating assets on your tax return at different times. And there's a really good way to save money if you do that, but it gets into the weeds a little bit. And then we have another contact who has a lead-based paint company. He's actually an investor from the Philly area, and he realized that there would be an opportunity every time a tenant moves out or every time a property is sold in Philadelphia, you have to have a lead-based paint cert done. And he developed a business around that newly formed law. And now he maybe bang every lead test in the city of Philadelphia. So he is a guy who graduated high school with. And Richard's chat says, my head looks fat. Love you too, buddy. Yeah, so there's some future meetup items. If you guys have any suggestions of things you want to learn, let us know. But it's always fun to get together and BS. So other than that, I'm going to stop the recording here, and then we're just going to keep the call up. If you guys want to talk amongst yourselves, we'll all be here for a while. I'm more than welcome to hang out to whatever. Did you have anything, John?
Good.
John just brought the food. Underwriting a deal. Yeah, there we go. We're going to underwrite a deal. Absolutely. What else we have? My head looks fat. All right, guys. Thanks, everybody.
Thanks, Matt. Great presentation.
Matt, thank you very much.
Thanks, Matt.
Really good presentation.
Thank you. Thanks.